Hello guys, let's talk about something that has quietly and genuinely make more millionaires than most businesses. As someone with a background in banking and finance and accounting, I can confidently tell you this. Mutual funds remain one of the most efficient investment vehicles for long-term wealth creation. The underlying word over there is what? Long-term wealth creation. Now, efficiency doesn't mean simplicity. So in this video, I'll break down to you in simple terms what mutual funds are, the types of mutual funds, the risks involved in investing in mutual funds, and how to choose wisely. That is the most important part of this video. How to choose wisely. You see, mutual funds are just like as a man or a young man getting married. You had no experience in what you are going to, but on that very day that you did the court one, a certificate is given to you. So the day you are doing that type of investment, that same day, a certificate will be issued to you. But the truth is that the details of those certificates, when you are about taking your money, is more important than the day you are doing the investment. Welcome to Street Finance. Now, before I define what mutual funds are in normal language, let me use this opportunity to say, Charlie, thank you to all who have been supporting this channel from day one. So today, I'm dedicating this video to Mira, my own brother, Gobo. Let's not waste much time. So we say mutual funds are a pool of money collected from many investors and managed by professionals. Get this right. Money is collected from a pool of what? Investors, individuals, organizations. So your association or anybody can invest in mutual funds. And not any ordinary people collect this money or manage mutual funds. Mutual funds are managed by professionals. When we say professionals, experienced people who know how to manage and make profit out of money. In simple terms. So they collect money from individuals who want to invest, who have money to invest. And then they look for areas that they think it is profitable to invest these monies because that is their work. So in simple terms, that is what mutual fund is about. Taking money from various people, individuals, organizations, associations, people who have money to invest. And then these professionals take this money and look for the best place to invest these monies. Now, what you must also acknowledge here is that with mutual funds, they are able, because it's a pool, they are able to raise huge sums of money. And I've already done a video on investment talking about interest rate. Every investment is tied to interest. So I said that interest rates are what? They are negotiable at any point in time. So if you're able to mobilize huge funds of money, you should be able to get what? Better rate. That is why a lot of content creators today will tell you, invest in mutual funds rather instead of doing personal investment. So on this channel, I will explain to you why they are telling you should invest in mutual funds. But I can say again, watching this video to the end is better than even starting to watching it now. So now let's go straight for what are the types of mutual funds. There are 4 major types of mutual funds. The first one we'll talk about is what we call the equity funds. You see, the equity funds simply means that they are investing in stock on the stock market. So when they take money from a lot of people, that big amount of money, then they take their time, use the experience they have, the histories. They invest in what? Profitable stocks, like stocks that are really doing well on the stock market. Like Apple, like, Tesla, all those good stocks. You understand? Now, what we must also understand is that with equity funds, which are the stocks, they are high risk funds. So we expect that you make high returns. The higher the risks, the higher the returns. I did a video on that one. The lower the risks, the lower the returns. So on this note, we go to what? The second type of mutual funds, which are the bond funds, or we call them debt funds. These are more or less low risk investment where they invest in fixed incomes. For instance, a government can decide that, okay, they want to build a port, and the government want to raise money from the people. The people who use the port, government want to raise money from its people. These are debt, debt funds. So the mutual funds, because they have a pool of money, pool of individuals who came together, they can have, a majority say in this type of investment. Why? Because when government say, okay, I'm giving 10%, or these are my thresholds, they can say, okay, look, we've been able to raise like 50 billion. So raising money 50 billion will mean that government should give us what? A higher rate than the ordinary person. That is why mutual funds are profitable as compared to individuals, because take part in negotiating the interest for their members. You understand? That is why a lot of people will advise you invest in mutual funds. So this is how mutual funds operate. When they take your money, they make sure they negotiate for the best interest for you, so that you can make something better than you going directly to the bank or directly to the government. On this note, we move to the third type of mutual funds. The third type of mutual fund is called the money market funds. Okay, here they are more or less investing in short instruments, like maybe fixed deposit. A mutual fund can decide to go to a bank and tell them, look, we have 100 billion and we want to invest in your fixed deposit for just a year. The bank could say that, look, our fixed deposit rate now is 10%. If the mutual fund with experts, they can sit down with the bank and tell them, look, we've been able to raise $3 billion US dollars. So 10% is not good for us. We are going to your competitor. If you raise this to 30%, we'll do business with you. In fact, the bank will give them coffee and ask them to sit down. Another person who is higher in authority is coming to talk to you. That's the negotiation table. That's the power the mutual funds have. That is why a lot of people will tell you invest in mutual funds. Now, let's go to the last type of mutual fund. This type of mutual fund is what we call the hybrid. The professionals, the fund managers, they take time and look at, okay, let's invest a little bit of the money we've collected from our investors. Some, maybe 50% into high risk investment, like on the stock market. Then we invest another 50% in in low risk investment, like the bonds and a fixed investment, so that if there is a sharp turn down, like the high risk didn't work, the fixed or stable income investment will match up. So our clients will be happy at all the time. If in other terms that the high risk challenge hit as our predictions, because in finance, they predict the future. If the prediction should come true, then it means that investors will be very, very happy with the company. So basically, these are the 4 major types of mutual funds. Now, let's find out, how does mutual funds, when they make profit, how do they share the money? That is an important question. Now, what you should also know is that mutual funds are not like, it's not a gambling place that, okay, one person wins everything. No, because these monies are collected from different quarters and different amounts. What it also means that when profits come, profits are shared proportionately. Just like back in the days when we do this one chandy, we contribute money to go and play match. What you contribute, when we win, you get part of the profit. If you don't contribute, you just enjoy the game. That has always been the policy. Those who contributed after the game share it proportionately. So when you bring more, you receive more. When you bring less, you receive less. It's not like because they've collected the money from different sources. So when you go and invest in 1,000, you expect that actually when they make a profit of 1 million, the 1 million is shared equally to everybody. No, the 1 million will not be shared equally to everybody. It will be shared proportionately. Guys, if you are still here, it means that Charlie, you love what you are watching. And just like and leave a comment, okay? And if this is the first time you are watching my video and you like it, Charlie, do subscribe to my channel on YouTube, KofizuluPodcast Media Hub on YouTube. On Facebook, it is Kofi K Zulu. On TikTok, it's Kofi K Zulu. And you can also follow me on other platforms on my Facebook page, which is Pulse and Perspectives with Kofi Zulu. I have that also on TikTok, Pulse and Perspective. Now, the last part of the video is where it is very critical. Many investors lose money, not because the investment didn't go well, but because of fees. You see, so far as professionals are going to be managing your funds for you, so far as professionals are going to be the one who will go and invest, look for the best places to invest your money. In fact, they expect it to be paid from your profit. So in that aspect, before you choose a mutual fund, these are the things you should look for. Now, you should look for one. In case I need my money in terms of emergency, we are all human beings. Can I come for my money? Yes or no? If no, then you know there's nothing you can do about it. However, if it is yes, it means that it will come with what? A penalty. You should ask, what will be the penalty? Or how much will I lose in case I'm coming for my money before the maturity date? 2, how much are you being charged as what? Fees when it comes to investing with the company. With some mutual funds, it's like one-time fee. Some, they have what we call the compounding fee, which means that at any point in time that you are making profit, they are also charging you out of your profit. So these particular ones are not that good for investors. You should stay far from institutions or mutual funds that charge you compounding fees on your profit. Now, lastly, you should also find out that in case your duration of investment is due and you want to take your money, will you be charged for taking your money? Is there any clause that say, okay, maybe they will want to reinvest the money for you again? You should find out of all these things. There's something called rollover. You understand? Rollover means that if the maturity time for you to take the money is due, the fund can automatically reinvest the money. You should find out about these things, because when you roll over your money, it's as if you have started again. So if you want your money during that period, in fact, you'll be charged a penalty. So you find out all these things. If you don't want your money to be rolled over, you don't accept those options. These are the most important parts of the investment. It's like going to marry a woman, and trust me, on that day when you are signing that contract, you don't know what is inside until that bell rings. Then they will count everything for you. Thank you for watching this video to the end. If you really enjoy this content, Charlie, trust me, bro. The only thing you can do to support me is to what? To share, like, and leave a comment. If there's something you want to add, you can leave a comment. Thanks for being part of this dream. I really appreciate your time.